Welcome to The Explainer. Jai, we're diving straight into what is arguably the most boring yet mathematically certain wealth building habit in existence. Seriously, we're talking about a strategy so mind numbingly simple, you might be tempted to just brush it off. But stick with me here, because understanding this one single autopilot habit, it's going to completely alter your financial reality. Okay, I want you to picture this. We've got two friends, both 24 years old. Their lives are identical in literally every conceivable way. They both pull in the exact same $42,000 a year salary. They live in the same unremarkable apartment complex, complain about the exact same student loans, and, share that exact same Sunday night dread about the upcoming work week. If you looked at them, you genuinely couldn't tell their financial lives apart. But let's fast forward 40 years. One of them is chilling on a front porch they paid cash for, happily retired at age 62. The other? Well, at 64, he's still hunched over his kitchen table on a Tuesday night, aggressively refreshing his 401k balance and doing the painful math on how many more years he has to grind before he can finally stop. So what happened? The only difference between these two friends is this absolutely massive $632,000 gap in their retirement accounts. And remember, they had the exact same income their entire lives. There was no secret inheritance, no lucky lottery ticket, none of that. The friend on the porch simply set up a $100 a month habit and invested it in a totally boring S&P 500 index fund. That's literally the whole secret. All right, section 1, the math behind the magic, exponential growth. Let's look at the raw, kind of uncomfortable math here. If we use a baseline 8% annual return, which, by the way, is actually below the historical long-run average of the S&P 500, and you just invest $100 a month, you don't increase it, you definitely don't try to pick individual stocks, you just leave it alone, after 10 years, you've got $18,000. A lot of people see that and just quit. But hold on. Look at year 20. You've only put in $24,000 of your own cash, but the market has handed you $35,000 on top of that. By year 30, the market has handed you over $113,000. And by year 40, get this, you put in a total of just $48,000 over your entire lifetime, but the market practically handed you over $303,000, all for the simple act of just not panicking. And if you run those numbers at the actual historical 10% average, that's how you end up with that massive $632,000 figure we just talked about. Now, I know what you're thinking. Let's do a quick reality check on inflation, because that is always the very first objection people have. Yes, inflation is going to eat some of that number, for sure. But even if we adjust for inflation and use a conservative 7% real return, your $100 a month still buys you $262,000 in today's purchasing power. Put that in perspective. If you just shoved your cash under a mattress, it loses about 70% of its value over those same 40 years. Not investing isn't playing it safe, guys. Not investing is basically a guaranteed, slow, polite mugging. Moving right along to section 2, the psychology of waiting, why people wait. So if the math is just so overwhelmingly obvious, why on earth do people wait? Well, it's because investing a mere $100 kind of feels insulting to our egos. It's like bringing a plastic Tupperware container to a 5-star restaurant, right? In behavioral finance, there's actually a name for this trap. It's called anchoring. Researchers at Seton Hall studied app-based investors and discovered something wild. The size of your very first investment essentially sets your baseline expectation and honestly your identity forever. If you're sitting there waiting to start until you feel like you can really invest some big, serious chunk of money, what you're actually doing is permanently setting your anchor at zero. Your default contribution just becomes nothing forever. You're waiting. You're actively choosing zero. And this brings us to a really hard truth. The reason you haven't started isn't that you can't afford it. It's that starting small just makes you feel small. We'd all much rather feel like someone who is eventually about to drop 10 grand into the market than actually be the person quietly investing $100 today. Both of those people exist in your head, but only one of them is actually real. Okay, section 3, the year 9 crossover, a money machine. There is this incredible, totally uncelebrated turning point where your basic savings account finally transforms into a self-sustaining money machine. Every single year, you put in your $1,200. And yeah, for the first few years, the market just gives you scraps. You're doing way more work than the market is. But then, month 104 hits, year 9. You put in your usual $1,200, and the market, quietly, without throwing you a party or even sending you a text message, just gives you $1,259. For the very first time in your entire life, your investments earned more than you contributed. You have officially crossed over from being a worker doing all the heavy lifting to basically being a passenger in your own portfolio. And once you hit that crossover, the math doesn't just accelerate slowly, it explodes exponentially. By year 20, your account isn't just matching your annual contribution anymore, it is earning 4 to 5 times what you put in. By year 30, it's earning 10 times your contribution. This crazy exponential acceleration is exactly why that guy on the porch got to retire early. He didn't out-earn his friend. He just got to year 9, and then year 15, and then year 25, while his buddy was still waiting around for the right time to start. Now contrast all that incredible exponential growth with this rather grim number, $38,176. That is the actual median Vanguard 401k balance right now. Half of all American workers with a 401k have less than that. But get this, if you just started that ridiculously simple $100 a month habit today, you would beat the median American's retirement savings in just 16 years. Think about that. A habit that is literally smaller than your monthly phone bill completely outpaces half the country. But honestly, the most important part of this whole thing isn't even the math. It's the identity shift. You cross this invisible line from just being a saver or a spender to actually being an owner. You start noticing little things like a 1% fee difference on your accounts because you now realize that tiny, seemingly harmless fee will literally steal $23,000 from your future self. You start to realize that $100 today is actually $1,006 future dollars. And suddenly, impulse spending looks a whole lot different to you, especially when you consider research from Empower, showing that half of every single treat yourself purchase you make has a happiness half-life of just 6 months. All right, section 4, 3 paths to wealth, real personas. So abstract math is one thing, but we live in the real world with specifics. First up, let's meet Ya. She's 22, grinding at a $42,000 entry-level job. She opens a Roth IRA on her phone and sets up a $100 a month auto pay straight into a total market index fund. She is totally 100% hands-off. Like, she literally forgets her password twice a year and has to reset it. But simply by being on auto pay and letting it ride for 43 years, she retires with over $823,000, entirely tax-free. Ya isn't some Wall Street financial genius. Ya is just on auto pay. Next, we have Jen. She's a late starter at age 35, a single mom who literally set up her 401k on her lunch break sitting in a Wendy's parking lot. She puts in her $100 and her employer matches 50%. She uses that employer match as an absolute math weapon. Over 30 years, she ends up with $223,000. Even as a late starter, she more than doubles the median 401k balance of 55 to 64-year-olds just by showing up and taking the free money. And then we can't forget Mark. Mark doesn't even start until he is 50 years old, acting completely out of spite after a snarky comment his brother-in-law made at a backyard barbecue. He is 28 years late to the game. But by sticking to the world's most boring schedule, he still ends up with $76,000 by age 70. That still beats half of mid-career America. Being late is significantly better than never, by a 5-figure margin. Which brings us to our final section. Section 5. 5 steps to autopilot. Execute the strategy. Okay, if you've been going through this explainer and you don't actually take action, we've totally missed the point here. So here is your 15-minute implementation guide. Step 1. Open a brokerage account with someone like Vanguard, Fidelity, or Schwab. It takes literally 15 minutes on your phone. Step 2. Inside that account, open a Roth IRA. Though, a quick caveat, if you have a 401k match at work, always take that free money first. Step 3. Pick one boring index fund, like a total market or an S&P 500 fund. Step 4. Set your $100 monthly automatic transfer to hit the day after payday so you don't even have a chance to think about it. And step 5, which is absolutely the most crucial one, do not check it. Doing absolutely nothing once it's set up is the entire strategy. Your goal is to be a sleeping investor for the next 40 years. You know, Warren Buffett famously compared compounding to a snowball. To build a massive glacier, you need a snowball and a very, very long hill. Setting up this $100 autopay, that's you packing your very first snowball. It's tiny at first, sure, but give it 40 years rolling down that hill, and it becomes completely unstoppable. The door to becoming an owner is sitting there, completely unlocked for you. It costs $100 and takes 15 minutes. Look, the right time to do this was 20 years ago, but the second best time is right now, literally while you're finishing up this explainer. So we arrive at the real question. Which version of you actually wins? Think back to those two 24-year-old friends from the very beginning. Here is the secret I didn't tell you earlier. Both of them consumed this exact same material. Both of them saw the math, both of them totally understood the year 9 crossover, and both of them reached the end. but only one of them actually pulled out their phone and set up the autopay. $100 a month isn't just a basic investment strategy, it's a vote on your identity. So what identity are you choosing?